Let us do the second part of the question. That is, on 1st January 2004, Gamma entered into a firm commitment to purchase a machine from a supplier whose functional currency is the kroner. Okay. The firm commitment was an onerous contract. The cost of the machine was 14.4 million kroner and the agreed delivery date was was 30th July for Gama purchase was due to pay 114.4 million kroner to the supplier on 31st July X4. So what we'll say, it's a purchase of machine, right? I'll give the heading purchase of machine. By the way, total 25 17 marks available over here. Now let's proceed with it. So what we'll say, the firm commitment to purchase the machine is non-onerous contract until the date of delivery. Therefore, the principle of IS 37 provisions, contingent liabilities and contingent assets, no obligation would be recognized in the financial statements of Gama until the machine was delivered. Okay. Now let us move to the further part of the scenario. We're saying on 1st January, Gamma entered into a forward exchange contract with the bank to purchase 14.4 million kroner for 1.44 million on 31st July. As for the forward exchange contract was entered into as to provide a hedge against the currency risk associated with the firm commitment to purchase the machine. Cool. Move to the answer sheet. What do you say? Under the principle of IFRS 9, financial instrument, the forward exchange contract is a derivative financial instrument, and so would be classified as fair value through profit or loss. This would normally means that gain or losses on remeasurement will be recognized in profit or loss. Right. Moving ahead, let's look at the slide further. On 30th June, Gamma took delivery of the machine and immediately brought the machine into use. Gamma estimate machine would have a useful life of 5 years on 30th June with no residual value. So what we will say further that we'll continue more with the IFRS 9. However, where the derivative contract is designed as a cash flow hedge of a future firm commitment, IFRS 9 allows the effective portion of the change in fair value to be recognized in other comprehensive income. They will be presented as gains which may subsequently be reclassified to profit or loss. Because the hedge is 100% effective, then in this case, the whole of the change in fair value of derivative will be recognized in other comprehensive income. So this means that a gain of 60,000 would be recognized in the other comprehensive income. Of Gamma for the year ended 31st March 2004 and a further $160,000 minus 60,000 $100,000 recognized in other comprehensive income of Gamma for the year ended 31st March at 5. Moving ahead further. On 30th June, after Gamma took delivery of the machine, immediately brought the machine into use. Gamma estimated the machine have a useful life. Okay. On 31st July, for Gamma paid 14 million, 0.4 million kroner to the supplier of the machine and received payment of 360,000 from bank in statement of forward exchange contract. Okay. And Gamma designated the forward exchange contract as a hedge of the cash flows expected to arise on the purchase of the machine. This contract was a perfectly effective hedge of these cash flows Gamma wishes to use hedge accounting to reflect the above transactions. Now here are the dates given to us. Okay, first January export rate 10, 9.660, 39 and 160, 31st July X4 and 360. Okay. Now we do not need to move to the slide again. So under the principle of IS 21, the facts of changes and foreign exchange rate on 30th June 2004 when the asset is delivered, the transaction will be translated using the spot rate at the date. So this means that 1.6 million. How I got it? See, 14.4 million divided by the 8, that rate 9. You get $1.6 million. It will be debited to property, plant, and equipment. And credited to trade payables. So under the principles of IFRS 9, given that hedge accounting is used, the cumulative gains on the remeasurement of the derivative which have been recognized to 30th June 2004 as other comprehensive income will be included in the carrying amount of property, plant, and equipment. So further, what we'll say that the cumulative gains have been accumulated in a cash flow hedge reserve, and the inclusion of these gains in property, plant and equipment will be achieved by direct transfer out of this reserve this transfer will not affect other comprehensive income, which means that $100,000 plus 60,000 will be, that means 160,000 will be debited to cash flow hedge reserve and credited to property, plant, and what equipment. Okay. So far, so good. Further, what we'll say that the property, plant, and equipment following this transfer is $1.44 million, and the property, plant, and equipment is a non-monetary asset. So its carrying amount is not affected by the future exchange rates. The property, plant, and equipment will be depreciated over its useful life. Years from 30th June 2000 X4. Therefore, depreciation of $1.44 million into 1 year out of 5 years into 9 months out of 12 months, obviously, is 216,000 will be charged to profit or loss as an operating expense for the year ended 31st March 2005. The closing balance of property, plant, and equipment on 31st March X5 is more 1.44 million minus the depreciation 216,000 is how much? Yeah, dollar 1,024,224,000. So that's it for this part of the question on my side to get the maximum marks. I hope it's clear to you. So see you in the next session.